Because Ross Stores and Deckers both jumping on strong results, and Denitsa Seikova is here to break it down.
Yeah, we're seeing very good news from retailers, which target actually very different audiences. If we start at Ross, we actually saw as much as an 8% jump earlier today based on better than expected earnings results and also good news in terms of profit projections. What we're seeing there is that this retailer actually lowered prices for consumers, and this is paying off. We saw comparing sales coming at the higher end of the range. We saw Morgan Stanley boosting their target to 161 following the results. Obviously, the brand is targeting those lower and mid-income customers. So potentially, we can see that those inflation pressures can be offset when the retailers offer discounts. And in Deckers, we kind of see different trends. Huge increase today, almost 13% based on their famous brands for running shoes, Hoka, which has been gaining so much popularity, and analysts are super bullish on it. If you ask Wedbush, they would call it one of the strongest offerings there are. They reinitiated their overweight, and now their target is $1,031. Obviously, the company beat estimates, and analysts are very optimistic about the stock.
And who am I? But I love Hokas. I've been wearing them since 2015, the maximalist shoe. Just think it's great. Anyway, Deckers shares up 11%. Denitsa Seikova, thank you for that. Let's broaden out this conversation on retail, because joining us now, I'm pleased to say, we have Joe Feldman. He is Assistant Director of Research over at the Telsey Advisory Group. And I mean, as you can see in the earnings that we were just talking about, it really feels like a tale of have and have-nots when it comes to the retail names so far this season. What's the common denominator in your sense?
Yeah, the common denominator to us has been that anybody offering value, discount prices has actually been performing a little bit better. I mean, you look at Walmart last week, really, really strong results. This week, you've seen it from TJX and Ross, as you just mentioned with Deckers. And, wherever there's that value and new innovative product, that combination really seems to work for the consumer. And we've seen consumers trading down to some of those discount operators, but also that core customer has been still staying within that and responding to some of the newness that they see.
Well, I think that's a really interesting dynamic, that you are starting to see more of those promotions, basically some of these retailers offering discounts to get that maybe reluctant, maybe tired consumer back in the door. But does every type of retailer have that lever? Who doesn't that work for right now?
Yeah, I think some of the guys that are smart about not pulling that discount lever or the promotional lever are the furniture guys, the furnishing guys. So like Williams-Sonoma had very good results the other day. Their profitability was through the roof. It was really strong, and they did not promote. Demand was a little soft, as it has been across all of the furniture and home furnishing retailers. But all of them have been very disciplined about not promoting. We saw it with our house as well, and some of the others, where they said, you know what? Just cutting the price of the sofa or the bedroom set isn't really going to drive more sales, so let's not do it. So I like that we're seeing that discipline for some of the retailers out there.
So that discipline clearly paying off for some pockets of the retail industry. I do want to talk about the fact that, you think about conservative guidance. It was interesting. We had Elf Beauty yesterday. You had Ralph Lauren delivering what a lot of people on the street said was a pretty conservative guide. And when you think about past economic cycles, periods of high inflation and weakening consumer strength there, is that what we should be expecting to see more of?
Yeah, I think the retailers are smart to be conservative with their guidance. And, we know that the first quarter has basically come in better than feared for a lot of the retailers, if not even just better, like Walmart was. But not getting too aggressive with their outlook for the balance of the year. I mean, we're still, there's this uncertain interest rate environment. We've seen inflation has been coming down, but not to the levels that we'd like to see in some of the services side of the economy. So that's still putting a lot of pressure on the consumer. And so you have some variables there that keeps the consumer spending in check a little bit. We're still seeing very choiceful spending. And that's why I think the retailers were smart to stay somewhat conservative. Let's not get over our skis here and say we're off to the races yet, because I don't think we are. I think they're also purchasing conservatively too. Inventory is still running pretty lean for most of the retailers.
Yeah, and I mean, to that point you made about that discipline, taking it, not too aggressively. I spoke to Elf Beauty CFO Mandy Fields yesterday. She said that company just taking it quarter by quarter. It feels like that's what you have to do in this environment. But we're talking a lot about the U.S. consumer. Let's go global. Let's talk about the Chinese shopper, because you think about what we heard from luxury, from some of the beauty names. It seems like a common thread there was that the Chinese shopper just still isn't there.
That's right. We're still not seeing the Chinese shopper come back in the terms of the travel to Europe, travel to the U.S. It's a little better in Europe, I believe, but the U.S. Travel from Chinese visitors is still not where it should be or where it was pre-pandemic, and that is weighing on the luxury retailers and luxury brands. We're hearing that pretty consistently. As that picks up, that should help, but that whole luxury complex has been a bit soft, and it's been challenging globally, for retail. I mean, we're seeing, kind of mixed trends around the globe in Europe and China, and we'd like to see more strength. I think everybody would, and that would help drive the industry a little bit.
What do you make of some of that softness in luxury? Because, of course, we can talk about the Chinese shopper, the Chinese traveler not being there like they have been in the past. But, I mean, the common narrative is that luxury is resilient to most economic cycles.
Yeah.
Is that still the case, or is something changing there?
Yeah, no, we view luxury as still very resilient. I think, what we've been noticing is it's that aspirational shopper that has fallen off a little bit on the luxury side, especially in the US and in Europe, where, maybe they would, that person that would buy that entry level Louis Vuitton handbag or something, or a wallet, that's fallen off a bit. The true luxury shopper really hasn't changed that much. They have been a little more choiceful in how they spend. You're still seeing travel spending. You're still seeing them spend on high-end experiences. But, I think that it's that middle or upper income consumer where we've seen some of the pressure. And then you add on, as you just said, the Chinese consumers not traveling as much and not spending as much on luxury. And that's been really the pressure point. But we think it'll bounce back in time. It's just we're not there yet.
Not there yet. I mean, you went where I was wondering, and that is the aspirational shopper still out there? In your view, they are. They're maybe just sidelined right now. But talk to me about the full spectrum right now. Let's bring it all together. We talked about some of the discounts that are happening. We talked about luxury. What about the middle? Does the middle just fall out here, and how long does that last?
Yeah, the middle is definitely where you're seeing a lot of pressure. You're seeing people being very focused on what they spend. They're trying to stretch their dollars. That's where you're seeing Walmart benefiting, where they're seeing more customers trade in. The dollar stores are seeing that. The off-pricers are seeing that as well, where customers are trading down. They're still shopping, but they are looking for value. They're looking for discounts. They're buying more private brands from the retailers directly. Smaller pack sizes for a lot of these people. So we're seeing the spend, but just not at quite a robust level. And people are being very choiceful in how they spend. So broadly, the consumer's pretty resilient. It's just we're not seeing that excess spending at the moment. I think people are still watching their pocketbooks just to make sure, where the economy is and how their personal finances are going to look as the year progresses.
All right, I think that's a good place to leave it. Joe, really appreciate your time on this Friday. That is Joe Feldman. He is Assistant Director of Research over at the Telsey Advisory Group. Now coming up, preparing for an Ether ETF.
I think it will be very important because if the SEC approves these, it really undermines the case that they're trying to make that Ether is a security. And so we think it will be very important for these to get forward, and we're encouraged by that news.
That conversation coming up next. This is Bloomberg.
I think the SEC is probably reading the tea leaves. They realize that it's very hard for them to continue to have this sort of hostile take towards the crypto industry. I think it will be very important because if the SEC approves these, it really undermines the case that they're trying to make that Ether is a security. And so we think it will be very important for these to get forward, and we're encouraged by that news.
Well, the crypto industry inching closer to another landmark, the SEC paving the way for the eventual launch of the first U.S. exchange-traded funds that invest directly in the Ether token. Joining us now is Eric Balchunas of Bloomberg Intelligence. And Eric, I know this isn't full approval. That point has been made to me many, many times. If it's not full approval, what is this?
I would consider it just about full approval. We'll call it 99% approval. We'll leave 1% chance for some complete black swan event, but you have to understand that the group that approved the 19B4 is under the same guidance of Gary Gensler. So he's not going to have one group approve it and another not approve it. I've also heard that the other group that's working on the S1s that are not yet approved, they're working on approving them. They're going to give comments probably very soon. There could be 2 rounds of comments. So we're thinking that the S1s get approved between 4 and 6 weeks from now. So we might be looking at a late June, early July launch of these ETFs. But we see no reason that there wouldn't be approval. So I think sometimes people like to get stuck in the technical side of it. And remember, this was a top-down 180. So it's not like one group in the SEC is going to rebel and not approve it.
Yeah, I think we are deep in the technicals here. Of course, you need 2 things. You need 19B4 approval. You need S1 approval. But leaving that aside, like you said, we're 99% of the way there. And let's talk about what the future could look like, because you think about the spot Bitcoin ETF launches, I think everyone underestimated the demand that we would see for those, just billions and billions of dollars pouring into that space. Could we see the same situation here? What's your expectation for demand for these spot Ether ETFs?
Yeah, my metaphor all along has been this is like the opening band having to follow the headliner. I think Ether is going to be 10, 15% maybe of the assets of Bitcoin ETFs. That said, that's a decent amount a decent chunk of change right there, because Bitcoin ETFs have 60 billion. If you look in Hong Kong, or you look at the futures market, or the futures ETFs in the U.S. or Canada, no matter where you look, Ether has a small fraction of what Bitcoin has. I see no difference here. Another metaphor would be silver. A lot of people who are regular 60-40 investors, they own gold. They don't really feel a need to go buy the silver ETF too. But there are certain people who just like silver. So I think that'll be the same case. I think a lot of people satisfied with Bitcoin being their sort of crypto hot sauce investment. But there definitely will be some who are interested or intrigued in Ether. There will be ETFs that come and combine the two. Those could get some bites. Overall, though, being in an ETF is being put into prime time. So for Ether, it's all good. It's all additive. But I just don't see them being, more than 15, 20% of Bitcoin tops.
Let's talk about who's who here, because you think about the Bitcoin ETF race, 10, 11 ETFs all launched at once. It's a space that's now being dominated by the likes of BlackRock and Fidelity with their new products. Who's in the running when it comes to the spot Ether race, when it comes to the actual issuer side?
Yeah, I would look for a very similar situation. It really does remind me of the Triple Crown. BlackRock, let's call them Secretariat. They're the odds-on favorite to win the next one, right? So if you have a company with a lot of assets and distribution and everybody's going out the same day, you got to give basically the favoritism would be correlated with assets and distribution. So BlackRock, Fidelity, Invesco, VanEck, ARK. I do think, though, that in this case, there could be 1 or 2 losers. In the Bitcoin ETF, everybody did well. I mean, even the lowest one was almost 100 million so far, which is a success. This case, I think there'll be 1 or 2 duds that just can't survive and probably close, but we'll see. But I'd have to give the odds-on favorite to BlackRock again. IBIT now is about to pass Grayscale GBTC, as you know, and I would think something similar with Ether, just because of their size and their just connection to all kinds of investors, retail, advisors, and institutions. They have a lot. Their tentacles spread far.
Their tentacles spread far. Let's leave it there. Eric Balchunas of Bloomberg Intelligence. Have a great long weekend. And of course, tune in to Eric and myself on ETF IQ coming up on Wednesday. That's 12 p.m. Eastern. It's a lot of fun. But before we get there, let's get some of the sector price action this morning. We're going to do that with Bloomberg's Simone Foxman.
Yeah, Katie, as stocks try to move higher on the day, we're looking broadly at sectors that are higher across the board. Every sector higher, led by consumer discretionary. We continue to get those retail earnings out. And energy and materials up for the day, though it's been a tough week for them. When you look at what's happened this week, the story has been about NVIDIA all week that we've been talking about. And frankly, the story here for Infotech has been strong as well. This is the 5th straight week of gains for the Infotech sector. But if you look down and dive down into the details, you'll see that Microsoft and NVIDIA, those are 2 of the 3 top holdings. They've had 5 straight weeks of gains. On the losing side, however, financials and real estate, tie that to what's happened in yields, this higher for longer narrative, continued woes in the property market, and finally energy has been bouncing back today after Brent hit a 3-month low, but energy producers and services have been hit. Exxon, Halliburton, both down about 5% this week. Katie.
Yeah, it feels like big tech, your only haven in this market. Simone, thank you. Coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg. All right, it's time now for the trading diary. What you need to be watching next week. Markets close in the U.S. and the U.K. on Monday. And then on Tuesday, we get consumer confidence data. On Wednesday, it's the beige book. On Thursday, even more retail earnings. Best Buy, Kohl's, and The Gap. And then on Friday, we get PCE, personal income, and spending data. That was the countdown to the open. Have a great weekend when you get there. But tune into Bloomberg Markets coming up the hour next. This is Bloomberg. All right, we are 30 minutes into the U.S. trading day on this Friday, May 24th. Here are the top stories we're following. Taking a breather. Goldman axes its bet for a July Fed rate cut as Bank of America warns that the stock rally is at risk of overheating. We're going to take a look at markets after yesterday's wipeout. Smaller waistlines ballooning production. Eli Lilly announcing it will invest over $5 billion to boost production of its weight loss drug. We'll have the skinny. And booze without the buzz. We're going to speak to the CEO of Curious Elixirs about the rising trend of non-alcoholic drinks as Americans fire up the grill for Memorial Day. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets on this Friday. Green on the screen after, of course, a disappointing day on Thursday. You can see the S&P 500 currently higher by about 0.4%. Of course, it fell by 0.7% yesterday. We're still marginally lower for the week. We'll see if we can bust out of that. Meanwhile, you take a look at the NASDAQ 100, also higher by about 0.5%. And it's the same thing if you take a look at the small caps, or Russell 2000, currently higher by about 0.6% or so. But let's drill down into Eli Lilly, boosting its weight loss drug supply. The pharma giant announcing it will spend $5.3 billion on its biggest factory yet in Indiana. The site will make the main ingredient in its weight loss drugs, including Zepbound. Of course, the popularity of the shot has led to shortages, and Bloomberg's Damian Gardy joins us now with more details. So you think about their quest to really boost production and really be able to address that demand. How far will this investment go?
So ideally, I mean, despite the ubiquity of these GLP-1 medicines, I think it sometimes escapes notice that they are technically in a shortage, Lilly's and competing drugs from Novo Nordisk. The idea behind this is to boost the production of the active ingredient, as you mentioned, although it doesn't address the immediate problem that Lilly is having, which is the auto-injector pens that distribute these medicines to patients. So this is more of a long-term bet from Lilly's perspective, that at some point when the popularity of these medicines makes them available to the millions and millions of people in this country and around the world to whom they are potentially beneficial, there might be shortages in the active ingredient, and Lilly is preparing for that eventuality. But the auto-injector pen issue remains an ongoing matter that the company is trying to deal with.
An ongoing matter. And I mean, the question that everyone is asking is, when we do get more supply, when that is actually actualized, will prices come down?
That kind of remains to be seen. Lilly is still fighting out with basically insurance companies and employers to get coverage of these medicines. The list price of them is unlikely to budge, but the actual net price that people pay, that's the subject of ongoing negotiations that Lilly has with the many players in the American healthcare system who determine what people actually pay for them. And the rise of more competition in this space, both from Novo Nordisk and from a handful of other companies developing weight loss drugs of their own, should probably in time push those net prices down. But we've seen curious things happen in American drug pricing to where that's not a guarantee.
Not a guarantee, of course. It remains to be seen, to your point, whether this produces lower prices, but a big investment from Eli Lilly nonetheless. Our thanks, of course, to Bloomberg's Damian Gardy. And let's turn to these broader markets now, because joining us is Aaron Kennan. He is Clear Harbor Asset Management co-founder and CEO. And I want to start with breath here, because you take a look at the week that was. Tech is the only sector in the green right now out of, 11? So what does that say about when we might actually see this rally broaden out? We've been waiting and waiting.
Well, it's interesting, Katie. You know, to your point about tech, it is the only sector, I think, the last 5 days that's in the green, and the overall S&P 500, as an example, is only down about 35 basis points over that same period of time. And so when you look at tech as representing almost a third of the overall market, we have a little bit of a window into that. But I think the broadening question is an important one. The Russell 2000 is not even up 2% on a year-to-date basis, even though that S&P is up close to almost 12%. And, you know, I think there's some sensitivity around the state of the consumer as it pertains to the domestic nature of smaller cap names. The broadening of that market is probably going to require more confidence that the consumer's in good shape. And keep in mind, the small cap part of the market is also much more sensitive to variable rates. And when you look at the balance sheets of those companies, I think about 40% of those balance sheets have significant variable rate functionality. With high interest rates, their margins are under a bit more pressure here. So I think we're going to have to see probably rates drop a bit as well.
Well, I want to talk about that a little bit more because as we referenced in the last hour, Deutsche Bank out with an interview saying that the stock market can thrive even if the Fed doesn't cut rates. But does that logic apply to that small cap space, which is really under pressure right now?
Yeah, I think it depends on the sectors and the opportunity set for sure. But, if you look at the consumer right now, unemployment is extraordinarily low, and I think the big variable will be if we start to see unemployment in the United States move above that 4% level, Katie, we could see a bit more pressure on the services, on the consumer and the consumption side of things. And of course, that could ultimately weigh on the non-technology part of the markets on the margin. But on the flip side, when you think about what's going on in the market and some of the sort of trends of change that we're seeing, look at just the Eurozone PMIs this morning. They were very strong, better than expected, back into expansionary territory. And then the durable goods data here this morning was quite strong as well. So it's buoying optimism that maybe the somewhat extended valuations that we've seen, particularly in the United States equity markets in the mid cap, large cap part of the market, could hold, and that they don't really augur a moment where we should be timing for a correction. Extended markets tend to not to be a great timing mechanism for those who are trying to figure out where tops are in the market.
What about a rate hike, Aaron? How much would that upset the apple cart?
I think that could certainly rattle markets, Katie. We came into this year where markets thought they'd probably see about 6 rate cuts. Even though the Fed's summary of economic projections were right around that 3-cut level for 2024. And now the market expects the next rate cut to be in September. And I think it's hard to argue that there's going to be one in and around the election. And so maybe we only see 1, possibly 2 this year. But I do think a rate rise would certainly rattle markets. I mean, there is this more sort of structural question around the last mile of inflation. We've gone from CPI at 9.1% in June of 2022 to below 4% today, but the Fed's target's 2, and the PCE is at about 2.8. And as you alluded to earlier, we're going to get a read on that again next week. Maybe it'll be closer to 2.5%. But if we don't have a lot of progress on that last mile of inflation towards the Fed's target rate, that's going to be a challenge. Keep the Fed more on hold. I still think that the balance of risk is for the next move to be a rate cut, not a rate hike. But we do have, important variables to think about as it pertains to that last mile. Deglobalization is something we weren't talking about 5 years ago, but we're talking about it today. The transition to renewable energy is something we're talking about today. That can incrementally be inflationary. And of course, deficit spending doesn't seem to be subsiding, and defense spending doesn't seem to be subsiding. And so those are not disinflationary pressures. Those are more incrementally inflationary pressures.
Right. And so when it comes back to the idea of a rate hike, though, it's not something that's the base case, but it sounds like you can't rule it out either. I want to switch gears a little bit, and I want to talk about M&A opportunities. It's something that you highlight in your note as something that could be a catalyst, some opportunities around here. When you think about where there could be M&A in this market, what are some of the sectors that stand out?
Well, these are sort of thoughts that came out of many earnings calls that we've been on here at Clear Harbor, where balance sheets are quite good at, many of these companies. And there's been some softening in the secondary market on the private investment side as well. And so if you look at M&A activity last year, it was off about 10% in the United States. And we think that, there may be an opportunity, even if rates remain high, for some companies to need to sell assets, to spin off assets. And we've seen some of that data. And so we think there could be ripe now for some sort of reacceleration on the M&A front. We've seen, of course, ExxonMobil buying Pioneer Natural Resources. That deal closed earlier this month. You just saw the DuPont story earlier in the week that they're going to be splitting off into 3 different independent businesses. And so I think it's M&A. It's also the spinoff. We saw GE spinoff. Now Anglo's up on the market. We have BHP Bulletin and Glencore looking at Anglo American. So there's a lot of activity right now, and I think we're also going to see it on the technology side. as well. And so that certainly can create opportunity for investors, both on the private equity side, but also the public equity side.
Well, Aaron, quickly, just like 30 seconds, I do find it interesting that we're talking about M&A and then we're talking about sort of the opposite of M&A, and that's spin-offs. You take a look at certain indexes of spun-off companies, and they're at all-time highs. I mean, what are you thinking around that space? Is that something that is an opportunity in your view?
I think we don't look at it as sort of on the financial engineering side. We look at each company for what it is. We look at management. We look at, the moat that they've created or haven't created. We look at their leadership position and their financials and their balance sheet. And so, we go back to the basics on every company that we look at here at Clear Harbor. But certainly, recent spinoffs, particularly on the GE side, there's some compelling opportunities there. For example, on the DuPont spinoff, there's a water business that they're going to be making public. We're going to want to take a look at that. May not invest in it, but certainly want to take a look at that because we think at a macro level, that segment of the market is of interest to of interest to us here at Clear Harbor.
Aaron, great stuff. Really enjoy speaking with you. Have a great weekend when you get there. Our thanks, of course, to Aaron Kennan of Clear Harbor Asset Management. Let's take a quick look at what's moving underneath the markets now. We're going to do that with Bloomberg's Denitsa Sekova, and a bad day for workday.
A really bad day. As we said earlier, it's the worst since March 2022. The company is suffering after it announced lower expectations for subscription revenue. Even though this quarter numbers came in line, this is not enough to bring optimism to investors. Subscription sales are projected to be significantly lower. That, of course, is a key metric for the company, which provides software solutions for managing personnel. The CEO is trying to bring optimism, saying that they're expanding internationally, going into new U.S. sectors. But you can see that on the street, the sentiment is very pessimistic. Bank of America just cut their target, and overall the price action is quite rough.
Yeah, down double digits for workday, and things don't look too much better when you take a look at Intuit.
Yeah, interesting enough, Intuit had a pretty strong earnings report. It actually saw a big increase in higher-end tax customers, but where investors potentially see concern as those lower-income consumers that access the tax software for free, their numbers are falling. So the competition for that part of the tax software space is getting more complicated. 10 million people use TurboTax for free this year. That is 1 million lower. So that is definitely bringing concern to investors.
Yeah, big time. Intuit shares down about 7.5%. And newsflash, Wedbush is bullish on Apple. Who would have guessed?
Yeah, that's the highest target on the street, 275 currently. And something that investors would love to hear, it's based on AI. They say iPhone demand turning the corner into an AI-driven iPhone 16 super cycle. Obviously, that has been a big issue for Apple. Everyone has been criticizing them that maybe they're a little bit behind. There has been concern about revenue growth. There has been concern about demand in China. And now we're seeing a strong month for Apple, the 10% up in May after a really rough start to the year. So potentially their deal with OpenAI could bring optimism.
Yeah, remains to be seen. Great roundup as always. Our thanks, of course, to Bloomberg's Denitsa Sekova. Meanwhile, the G7 finance meeting underway in Italy. Finance ministers and central bank governors are gathering to discuss the issues facing the global economy. Along with them is Bloomberg's Oliver Crook, who joins us now with a special guest for an exclusive interview.
That's right, Katie. Thank you so much. Yes, I'm very pleased to be joined by Joachim Nagel, who is the president of the Bundesbank and, of course, ECB Governing Council member. Thank you so much for joining us here in Stresa, Italy, to discuss some of the main themes that we're dealing with here at the G7 finance ministers and central bankers meetings. I'd like to begin, if we can, on some of the data we've got this week out of the Eurozone. We really had a very, very strong wage print for the first quarter. How is that affecting your thinking about where rates should go? Particularly since we're expecting inflation to tick up next week, is it really appropriate to cut rates under those circumstances?
I think, first of all, it was not a surprise to me that wage data came out pretty strong. I think wage data is often a kind of a lagging indicator. So what we saw in the latest data is related to the high inflation rates of the past. A lot of one-off payments are included in the current wage data. So my expectation is that there is a flattening of the wage data that is occurring over the next months. So I believe that is some relief coming also from the wage data side. But nevertheless, wage data are still strong. So we have to keep our vigilance when it comes to the next rate decision.
So it sounds like it's not concerning you that much. That being said, next week we are expecting inflation to come back up in Germany, in Spain, in France, in the Eurozone, core to sort of slow its descent. Does that not concern you?
I think as a central banker, you're always being concerned. So, but what I see, the trend is the more important issue here. What I see is that over the last couple of months, inflation rates came down. So what I expect also for the next months, that inflation is coming down further. Core is coming down, headline will come down, came down here already. So what I see is that the probability is increasing that in 13 days we will see the first rate cut in the Eurozone.
And beyond that, do you think that we can rule out then back-to-back cuts given the sort of uncertainty on the outlook for inflation?
I think I believe this is a very important point. There is not a kind of an autopilot that when there is maybe the first rate cut, that there is a consequence, maybe let me say, more rates cut coming. I think this is something, I believe this is not helpful, this discussion. What did we really right over the last 2 years is that we really followed the meeting to meeting here understanding, and I believe that should still be the case. So if there's a rate cut in June, we have to wait, and I believe we have to wait till maybe September, I think July. But as I said, it is too early to speculate.
Maybe difficult to give forward guidance, do you think, under these circumstances particularly?
I think, or I believe that forward guidance was helpful maybe in an environment where there are blue skies, sun is shining, but now we are in a world that is more difficult. It's a very uncertain world, a lot of geopolitical risks. So the data that is incoming is the most important indicator that we have to follow.
And some of the clouds in that sky has to do with the sort of trade action that we've seen out of the United States, raising trade barriers with China. We're expecting the EU to do something similar with EVs. I'm sort of interested in how you see that playing into the inflation story. Could you see prices going up as a result of more protectionist policies?
We shouldn't forget that most of the things we discuss here, wonderful, Stresa has still to do with that unprovoked war of the Russians against Ukraine. And this is still the main factor. So we shouldn't forget what's going on here. The trade issues are becoming more and more important. Fragmentation seems to be something we have to deal with, deglobalization. But we also should take into account that fragmentation is harming economic wealth, economic growth, and we should find a smart way how to deal with this.
And so another bit of fragmentation or perhaps divergence you can find between the Fed and the ECB and what we're seeing with rates, and I don't want you to comment on the Fed or see how it bears on the ECB, but I'm curious to know, because there are people on both sides of this, is the divergence between the Fed and the ECB, is that inflationary for Europe or disinflationary?
First of all, we have also to take into account that the situation in the United States is different from the Eurozone. The situation in economic terms in the United States is stronger than in the Eurozone. Inflation in the United States seems to be a little bit more sticky than in the Eurozone. What I would like to say was this, that we have to do monetary policy for the Eurozone. This is our task, this is our mandate, and we are on a good track. Inflation is coming down. But nevertheless, there are some spillovers. Take, for example, the economic models we are using. So there are some, let me say, feedback loops. What happened in the United States has some impact on the data we are using. We are not more or less completely here independent from what's going on in the United States.
Do you have clarity on what that impact is, or is it hard to tell?
I guess we have a good understanding what's going on there, but all what I see, taking the Eurozone data, and this is at the first level, this is my first line of defense, and I have to look what's going on there. This is of the, let me say, highest importance to the Governing Council, and what I see there is absolutely giving me a here is the confidence that I have that we can maybe, with a high probability, lower rates in our next meeting.
And I want to talk also about sort of the EU election, which is just about 2 weeks away, and some of the political stories that we've felt certainly in Germany, certainly the rise of more extremist anti-democratic portions within Germany. You've been very vocal on this. You've joined sort of protests. What do you see as your role and your responsibility there, and what effect do you think that has? Joining these protests?
I think over the last 70 years, Europe is an achievement. We achieved a lot in terms of democracy, freedom, and it was important to me to get out to really address all these issues, that the danger, that I see the danger, that maybe some groups that are jeopardizing all what we achieved over the last decades. And so I believe it's even for a central banker. I think this is also influencing the economy here in Europe. I would like to see a Europe with a lot of diversity, freedom of speech, and this is important to me.
And I think that potentially, though, some of the reaction, some of the reason that you see people moving in that direction is because of the fear, economic uncertainty, whether it's the energy crisis in Germany, whether it's, rising costs, even AI and these sorts of things, and sort of losing faith in the mainstream approach to this. How do you reinvigorate credibility in the sort of mainstream approach to solving those economic fears?
I'm not sure if these are really the root causes for those that are arguing against Europe. I think what I can deliver as a central banker is price stability. This is my mandate, and this is what I will deliver at the end, and this is what we will deliver in the Governing Council. But beside that, I believe it's also important that the representatives of organizations, institutions like the Bundesbank, they are really clear here what Europe stands for. Europe is an achievement. It brought a lot of, let me say, growth, wealth for all Europeans, and it would end up in a kind of a catastrophe to giving up on that.
And while you mentioned your mandate, there was this big speech that Emmanuel Macron gave a couple of weeks ago. In there, he did mention the ECB. He talked about maybe targeting growth, maybe talking about carbon transition. What is your reaction to that when you hear Emmanuel Macron saying that?
President Macron is an inspiring leader, so I appreciate everything what he is saying about Europe. Regarding the mandate of the ECB Eurosystem, I have a little bit of different understanding. I think it is complicated when we are trying to think about to maybe come to dual mandate or doing much more, and I believe it wouldn't be too much on the shoulders of the Eurosystem. So we should really stick to our mandate, achieve price stability, and I alluded to that. This is the best thing we can do for the economic situation in Europe.
Well, Joachim Nagel, thank you so much. That's the president of the Bundesbank and ECB Governing Council member joining us here at the G7 in Stresa, talking about all the sort of fundamental issues that are being discussed here and also beyond.
All right, our thanks to the Deutsche Bundesbank president, speaking there with Bloomberg's Oliver Crook. This is Bloomberg. It's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, Lucid will cut about 400 jobs in the coming months thanks to slowing demand for its EVs. It comes on the tail of layoffs announced at both Tesla and Rivian. Next up, it's a Bloomberg scoop that sizzles. Burger King taking off the gloves as it unveils its own $5 value meal that will launch ahead of McDonald's. Now, the tit for tat between the burger giants, it really underscores the pressure to attract budget-conscious diners feeling the pressure of higher prices. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Let's take a look at these markets because we've seen a little bit of an interesting reversal when it comes to the bond market after we got those University of Michigan numbers at the top of the hour. I want to focus in on inflation expectations. 1 year inflation expectations came in at 3.3%. The survey had said 3.4%, so a little bit of relief there. The 5 to 10 year inflation outlook coming in at about 3% there. The expectation had been for 3.1%. So some good news there if you're the Federal Reserve, and you can see that in the 2-year yield. We had been higher heading into the print, but now we're just about unchanged on the day. As you can see there, the 2-year yield currently trading at 4.93%. We are below 5%. Meanwhile, you take a look at the S&P 500 building on its gains, currently up about 0.5%. Again, we are lower on the week, but just slightly. So, of course, it'll be interesting to see if we can get there. Meanwhile, you take a look at the dollar right now. A little bit of softness there as rates do come down slightly from their highs. The Bloomberg Dollar Index currently lower by about 0.2%. Now, coming up, no more poor decisions. We're going to take a look at the brewing battle for the sober, curious consumer. J.W. Wiseman, he is the Curious Elixirs founder. He's with us next. This is Bloomberg.
Great questions.
Well, the booze-free movement is gaining steam as younger consumers rethink their relationship to alcohol. Research shows that nearly 40% of all Americans are trying to drink less, including 60% of Gen Z. For more on the business of the Sober Curious movement, I'm pleased to say we're joined now by J.W. Wiseman. He is the founder of Curious Elixirs. It's an alcohol-free cocktail brand. It's great to have you here in person.
Thanks for having me, Katie.
So you founded this business in 2015. What was the state of the non-alcoholic industry all the way back then?
Practically non-existent. You know, when we started in 2015, you know, I wanted to drink less. One of my friends had gotten sober, and when we went out to restaurants and bars in New York, you're lucky if you could find a ginger beer, you know, and I just got really tired of club soda, and I've been a cocktail nerd for a long time, so I started Curious to make the world's best non-alcoholic drinks, something fun when you don't want to get wasted.
And what was the catalyst here? Because you think about how the industry has grown from virtually non-existent, like you say, back 9 years ago to now, it feels like it's the hot new thing, especially with Gen Z. I mean, is it just demographics? Was it the pandemic? What was the catalyst here?
I think everybody's waking up to ask themselves the question, what do I want my relationship to alcohol to be? And so people are asking that questions, and now companies like ours are making solutions for them to still unwind with their friends, to help business owners make more money if you're a restaurant or a bar or a hotel or a business conference. You know, that's really what's going on. The pandemic definitely accelerated things for us because some people drank a lot more during the pandemic and some people drank a lot less. But we just saw our sales skyrocket from 2020, and every year has been bigger.
Yeah, I mean, you think about the effects of the pandemic across industries. It's just really interesting and in some cases unintuitive. But let's talk a little bit more about your product because it's not just alcohol free. You do put adaptogens in there as well. Just briefly, tell us what adaptogens actually do. Do you get some sort of buzz or effect?
No, we're not trying to make drinks that give you a buzz. We're trying to make drinks that help you de-stress. You know, so for example, in Curious Number 1, we use rhodiola, which helps balance your cortisol, the kind of pain molecule levels, and it helps increase your serotonin and dopamine precursors. So that just basically means that you've got more of the raw materials for feeling a little bit of joy. Does that make sense?
It does make sense. So you feel something. I guess the only way to really know the effect is to try it. But I do want to talk a little bit more about demographics because we read some of the research. It really seems skewed here to Gen Z. But what do you see in your own lineup, in your own customers, when it comes to actual demographic trends?
There's 3 massive cohorts. So one is going to be people kind of over 40. They just want to drink less. They still want to unwind with their friends. Then there's people in the millennial group, and there's people in the Gen Z group. You know, and these are people that are either sober or just cutting back. But they're really defining on that sobriety spectrum where they want to be. And so it's just everybody's trying to find it, and they're coming for 1,000 different reasons, whether they're pregnant, training for a marathon, they want to lose weight, have better sleep, better sex, any of that stuff. There's lots of different reasons why, but it's happening across every single generational cohort. That's what's amazing about it. You know, I think that Gen Z and millennials get a lot of the attention, but the truth is that it's happening across every single segment. It's wild.
Yeah, I remember I used to talk about it with my parents, and the narrative was it's just fancy juice. It's just soda, but definitely the conversation now has changed in terms of the perception across generations of what non-alcoholic drinks actually are. And I mean, to that point, how big do you think that this market actually could get?
Oh, I think that this is the first act of the opera. You know, we're on the kind of ascendancy plane, and there will be a pendulum swing back. But, you know, some people think that it's going to be a $20, $30, $40 billion industry. It's about $11 billion right now, but it's going to continue to grow. It's growing by 10%, 20%, 30%, depending on which, you know, if you're talking about an individual company or the sector as a whole. It's growing every year since we've started in 2015.
Well, with that growth, of course, you have some of the big brand names coming in. You know, your traditional alcoholic beverage makers coming in with their own versions of their non-alcoholic product. How do you compete there? What's your plan look like?
I think it's wonderful that they're coming in. It's helping to validate the market, and it's helping to educate everyone that there are better options out there and that better options are possible. I would just caution every consumer, read your labels. Look at what's going into it. Just because it's non-alcoholic doesn't mean that it's good for you. So pay attention, listen to your body when you're drinking or taking anything, you know? It's really up to the individual to see how this can make an impact in their social life, in their physical life. and how they can enjoy life with less alcohol.
And who do you feel that you're competing with? I mean, is it other pure play non-alcoholic brands? Is it sort of the big alcoholic beverage makers coming into this space? Or is it something like marijuana? We read a stat on the show yesterday that more Americans, for the first time in a long time, are smoking marijuana daily as opposed to drinking daily.
Mm-hmm. I think that with what Curious does, I mean, we're out to make something special and unique, the world's best non-alcoholic drinks, and they're inspired by craft cocktails, but they're not trying to emulate something else. They're trying to be something new. So that's really what we're focused on, is making something that's different than everything else out there, and that just makes people feel a little bit happier, a little bit more included, and helps make business owners, especially restaurateurs that are struggling right now, make more money with the same guests that are already coming into their establishments.
Well, I'm glad you brought up restaurants, because that's what I'm also wondering is how you get your product in front of people, whether it's really direct to consumer sales, or are you trying to get this in bars and restaurants?
It's both. That's really like the two major prongs of our strategy, is build a really robust direct-to-consumer business and also build it on premise in establishments where people deeply care about taking care of their guests. For example, Blue Note Jazz Club is one of our accounts. They sell over $12,000 extra a month just of Curious to people that are already coming into their jazz club. So that's just, if you're not having like Curious on the menu, you're leaving money on the table.
Yeah.
You know?
So, I mean, what would you say is the more important prong right now? Like you said, it's a two-prong approach. You want to be direct to consumer. You also want to be in bars and restaurants. Which is more meaningful for you right now?
I think in terms of lasting cultural change, it's going to be more important for us to continue getting into restaurants, bars, hotels. We're in a few thousand right now, but that's a far cry from being in 100,000, 200,000 venues. So that's really what we're going to focus on the next 10 years. We're just about to celebrate 10 years in being in business. The next 10 years is about working with different groups of professionals, particularly on premise in restaurants, bars, hotels, resorts, so that they have something that can help educate all of their existing clientele and make them more money. And everybody that comes in for that experience, whether it's a restaurant or a Broadway show, they have a better time. They feel included, and they still get to celebrate and kick back with something that's delicious.
And I do want to talk a little bit about what's next for the business. I asked you before the segment started whether it was safe to call you a serial entrepreneur because, of course, you founded a marketing agency in the past. You've built bars and restaurants, and, of course, you founded Curious Elixirs back in 2015. Would you be open to a sale? What are your plans for the future?
Right now, we're focused on growing sustainably and just continuing to invest every dollar that we have back into the business to help create this lasting generational change. Our mission is to transform how we drink socially through the best non-alcoholic drinks in the world. That's really our focus right now. We're not focused, since we're continuing to grow, we're not focused on selling our business. We're focused on making sure that these changes don't repeat the mistakes of prohibition. It's not that alcohol is a problem, it's that too much alcohol is a problem, and we need better solutions to make everybody feel included when people are already trying to drink less. So that's really what we're focused on. We just launched our most recent flavor, Curious No. 9, and we did that at a party in 100 cities all on one night. It's called the Great Curious Cocktail Party. We did it last week, and that's the sort of thing where 100 different hosts get together and throw their own parties. That's what makes lasting cultural change when people are invested. Those are the sorts of things that you're going to continue to see from us.
And that's a rosé, right?
Yeah, that's our Rosy Rosé with fizzy lifting lime.
Yeah, it's a great drink for the summer. It's a good place to leave it. Really great to see you in person. Our thanks, of course, to J.W. Wiseman of Curious Elixirs. Let's get a check on these equity markets right now. We're going to do that with Bloomberg's Simone Foxman.
Yeah, Katie, we're seeing gains in the S&P 500 today, but as you can see, it's been a rocky week, though we are eating away at some of those losses from earlier of the week. Part of that has been, what is the Fed going to do, and when will they go ahead and cut rates? At least at the moment, the message higher for longer. The 10-year yield, we're looking at 5 basis points higher than the beginning of the week. The U.S. dollar as well, on pace for its best stretch since April 12th. Meanwhile, we're looking at some declines this week, even though we've seen a little bit of a reversal today in the price of oil. WTI actually hitting its lowest levels since February 2023 earlier this week. Watch out for this, though, because we have an OPEC Plus meeting coming up on June 2nd. So we do expect those oil supply cuts to remain in place through the second half of the year. But but who knows? Looking at the commodity sector overall, what we are seeing is some of the biggest pullback a big pullback since hitting its highest level in about a year here. A lot of this has to do with industrial metals, according to Oxford Economics, and they say a lot of bulls piled into the commodity space, especially the metals space, after the China reopening trade in late 2022, and now they have gotten over their skis. We're looking at gold down about 3% last I checked. Potentially the biggest loss for copper since February after it hit an all-time high Monday. Finally, I know you're paying a lot of attention, Katie, to what's happening in the crypto markets, and you'll be talking more about that today. But yesterday, the SEC signed off on a proposal by the CBOE, NASDAQ, and the New York Stock Exchange to allow products tied to Ether to be listed. We've seen Ether jump about 20% this week. Bitcoin's roughly flat. But I think the story here is what the impact of allowing exchange-traded products has been. We're looking at we're looking at the price of Ether and the price of Bitcoin both up about 60% this year, Katie.
Yeah, it's going to be fascinating to see what demand for those products looks like if those spot Ether ETFs do get the green light to officially list. Our thanks, of course, to Bloomberg's Simone Foxman. Now coming up, picking up the post-COVID pieces, restaurateur Melville Wilson highlights the new normal for eateries in the wake of the pandemic. This is Bloomberg. right, it's time now for Wall Street Week, and today we're talking about the lifeblood of New York City, its restaurants. Melba Wilson opened her restaurant, Melba's, nearly 20 years ago. David Weston sat down with her to talk about the challenges that she's faced and, of course, what's next on the menu.
I'm born, bred, and buttered in Harlem, and 114th Street in Frederick Douglass was one of the most notorious drug blocks in the community. There's a school down the block, like midway down the block, and it broke my heart to know that school kids on their way to school to learn had to witness that type of activity. And I always said, I complained about it. And I'm like, but what am I going to do about it? Well, on a flight one day, I heard the flight attendant say, like they always say, in case of an emergency, put on your mask first. And I said, how am I putting on my mask? How am I changing my community? Well, I went home that day, and my parents are from the South. Literally, my father's from a very, very small town, 3 stoplights, Hemingway, South Carolina. So they grew up saving money under their mattress. They didn't trust the banks. And at one point, black people could not bank anywhere. It's like their money wasn't good. So there was a habit that was formed. It's what my grandmother did, my great-grandmother did. They would take money and put it under the mattress. So what did I do? When I got paid, whether it was at Sylvia's or Rosa Mexicana or Windows on the World, every Friday when I got paid, I put a little bit under my mattress. This particular day, I said, let me see how much I've saved up. Well, I started counting and counting and counting. Then I got scared. I'm like, oh my God, it's a lot of money. I saved up $312,000.
In cash? In
cash. $5 bills, $1 bills, 20 hundreds. But I said, what am I going to do with this? And I decided to change my neighborhood, to be the change that I wanted to see. Well, on the southwest corner of 114th Street, there was a space on the corner, and it said, for rent, written in a black Sharpie with a phone number. I called the number, and the gentleman said, well, have you ever opened a restaurant before? I'm like, no, but I've worked in a lot. And he said, well, can you come and meet with me tomorrow? I said, sir, can I come today? His name was Robert Reach from Limley and Wolf. I trekked further uptown, because I was already uptown, went and met with him, and the rest is history.
How did you suffer through the pandemic at Melba's?
The pandemic was a really, really rough time for us. New York City is a city that never sleeps. I heard that the city was going to shut down. Did I believe it? Absolutely not. You can walk down the street at 3 o'clock in the morning and find a vibrant community filled with music and sights, some unseen, but still sights none the same. So to believe that New York City was going to shut down, never. But it did.
So now that we have fortunately come out the other side, it appears, that pandemic, how is Melba's different than before the pandemic? I mean, do you still do dine out, for example?
Well, now we have outdoor dining. We had never had outdoor dining before, so that's different. But we've also really reached into innovative technology. Like a QR code, come on now. I'm a little bit over 40, definitely over 20. So QR codes, who would ever thunk that these are something that, so we've become, because you couldn't really touch the menus, right? We didn't know what to do, what not to do. So QR codes, we've become more tech savvy. And that's really, really helped. And also when you look at back of the house and front of the house, that's always been a big deal in the restaurant. It's the tale of two cities. Now there's one house. And COVID really taught us that. We have to work together as a team. And as president of the New York City Hospitality Alliance, a former president, I just stepped down from a 4-year term serving 5 years, where you have some of the biggest restaurants in the city, Tao, Lavo, and then you have the small mom and pop restaurants as well, like a Melba's. We realized that we reached into each other. We reached out to each other. We tuned in with each other. But most importantly, we were there to support one another.
So you talk about help you got from other restaurateurs, for other restaurants, and yet there's a lot of competition among restaurants too. How does that trade-off happen? When are you cooperating? When are you competing?
Oh, there's a lot of competition. But ultimately, there's also camaraderie. It's so interesting. I'll never forget when I would go meet with Drew near Parent, and there would be Tribeca Grill on one corner. But then there's Nobu at the other corner. And I would think to myself, aren't they competing with each other? Because that's what I was taught. That's what I was raised to believe. No, what they're doing is that you might go to Tribeca Grill today, but then you'll go to Nobu tomorrow. When I first opened Melba's on 114th in Frederick Douglass, there was no other restaurants in that block. There was the Chinese restaurant, takeout, down the street on 112th in Frederick Douglass, and between that and 120th Street, 110th and 120th,